Yeah, that works. Okay, so welcome to Retire into the Stock Market Session 9 with Mark. We found a new stock today. What is it, Mark? Tell us.
Palantir. This ticker symbol is PLTR.
Palantir. Okay, give me the price of that today, please.
Yeah, right now it's at 25. It closed at
25.
24.74, but after hours now it's at 25.
Give me the daily close, 24.74, and do you have the change on that for the day?
Yeah, that'll be a change up $1.15.
Plus 115. And notice that the market's down today, right?
Mm-hmm.
So the market's down. What's the Dow Jones down?
The Dow Jones, let's see right now.
I think it was down 345.
Yep, down 345.
And then what's the number? 345 to 30,000. What?
Now it's at 30,924.14.
So the market's down, but if your stock is up. So that's always a nice thing if you can have a stock that's up, which is we call it bucking the trend, right? So a lot of times when the market's down, all of our stocks are down, or a lot of our stocks are down. But if you have a stock that's up, that's great. It's just something, it's just a little bonus. So this stock was up today.
Mm-hmm.
It's a new stock. It has not forgone the test of time. It started as IPO in September. So technically it's like 9, 10, 11, 12 months. It's like 5 months old.
That's a baby.
So I'm not advising it, but it's worth it for a couple of things. One, it has a very high cover call return. They're paying about 10% a month for the higher strike price. You can get more than that if you buy a low at the money, a lower strike price. For example, I looked at the 27th for April, and that's 5 weeks out. April 27 call was 241 when I looked at it. So that was like 9.9% return for 5 weeks. 5 weeks. In theory, because there will be exceptions, do this trade 10 times a year. This is what I'm teaching. To get a good cover call trade or any good trade, 10 times a year. I'll give you 2 months breathing room. Year. We're making 99% return. Does that make sense?
Mm-hmm.
Can we beat the market if we did this trade?
100 out of 100 times. Yeah.
Now, Palantir will probably go all over the place, probably go up, down, sideways. So we probably won't get 99% return. We'll probably get, less because we have to buy it if it goes up and it takes our strike price out. It'll sell at the higher price, buy it back higher, our cost goes up. And also there'll be months where the stock will come down, say to 20, and then we'll still have to write the cover call. So we'll have to write the lower cover call, so we might lose some share growth from the price we bought it. And that's okay, because what I'm telling you is you take a good stock, in this case, let's say $25 stock. If you're getting anywhere between, we usually get about 3%, 3 to 4%. But in this case, we're getting 10%, close enough, 10%. That's $2.50 per share per month. Am I right?
Mm-hmm.
So this is going to bring us, what I see is going to bring us 2.5 points a month times 10 months is 25 points a year. So I'm looking at the income of basically 100% income a year. Now you can subtract share growth or share loss, let's say it's 20%, right? We're still making 80% return. Even if we have 25 points in share growth loss or higher cost, write this down. Share growth loss, or higher cost. Let's say minus 25%. We still have 75% gain. And in this case, what's 75% of $25?
35.
Do the math for me.
Yeah.
Give me a dollar figure.
$7.50.
Okay. I think that's 25%. That's the loss. So 750. So we're going to subtract 25. We're going to subtract 750 by 25. We're going to get what? 17.
Yeah, 17 and a half.
50. So here, even if we do it, if we make a few mistakes, if we have some losses, we're still going to get 1750 income on this. So it's basically like investing in a stock for $25. We're getting 1750 back at the end of the year, and we still have the stock. So that's a great return by any means. No, there's no profit in this stock, so it could go either way. I guess it's a hot stock. So we'll look at it, we'll watch it, we'll consider it. We're not going to throw all the money into it. Maybe we'll do a small position. It has a volume. Can you tell me the volume today, or average volume?
Yeah, I'll give you both. Volume on the day was 158.76 million, and their average is 172.21 mil.
So a lot of people are in the stock. So the security of the volume is that when the stock dumps, a lot of people will come in and buy it up. You see? So that's an advantage to have more volume, because there's a lot of investors putting their money into it, and they're going to buy the dip. If you have a stock with little or no volume, basically if someone dumps that stock, whoever had it, who knows about the stock, nobody's going to come in and save it because nobody knows about it. Right.
Yeah.
And volume is one of our requirements. So we'll put a check on volume. Requirements for stock selection. And cover call income is another one of our requirements. So we have both. We have two. We have 2 of 10 at least. You can probably find another requirement if we go down our list, but at least we have 2. Okay, so what else? The market was down today, 345 points. This is a good day to talk more about trading and talk a little bit about losses. A lot of investors don't like to talk about losses, but you have to know this stuff like the back of our hand. We're going to use a word it's called drawdown. Draw down. What that generally means is, in the basic sense, is it means what can your account go down to? What's your exposure of loss? If you have like stable stocks that don't swing too much, like you have dividend stocks, right? Remember we had
isn't the drawdown just everything that you've made on the year?
No, it's the loss potential.
Yeah, loss potential. So I'm saying, let's say you made $5,000 off of your trading, covered calls, dividends, all of them. Let's say you just made $5,000, and now market becomes bear, and isn't your drawdown now $5,000 because you're up $5K?
No. What I use it for, the drawdown, is the total maximum potential you can lose.
Gotcha.
So, in a basic sense, if you're in the dividends and the stocks don't move too much, you're gonna have a lower drawdown, right?
Mm-hmm.
Or less chance to lose money. If you have volatile stocks, what would they? Nvidia, Netflix, right? Your drawdown is going to be increased, so it'll be more risky, right? And then if you have call options, put options, that's a maximum. So it's about maximum risk you can have with those guys, right?
Yeah.
Then your drawdown is a lot higher, and you have to control your account. We have to be responsible for our trades. We have to be accountable, and we have to be transparent. So we have to look at our account, and if we have a loss, we have to act on it, correct it if possible. And I'll give you a couple strategies today to protect us from losses. Would you like that?
Yep.
Today's the 4th.
Time is really flying. It's crazy.
It's already March, man. All right. Hey, did you look at GME stock?
No, I haven't.
Pull it up. Pull it up.
They closed on the day at 132.65.
Do you have the change for the day?
Yeah, let me get that. Let me just write it. 132.65. On the day, they were up $7.67 dollars.
Amazing, huh? And so sometimes it's very hard to predict stocks, to forecast, and the best thing to do if you're wrong is to just close out the position and then reevaluate. I think that's what you did, right?
Mm-hmm.
If you are wrong forecasting a position, best thing to do is close out and reevaluate. You can think much better when you're out of the position. When you're in the position, if you're losing money, you're like, should I buy? Should I sell?
Yeah.
So let's talk a little bit about trading today. Do you have any questions trading for me? As far as we've covered a lot of stuff. Let's first talk about the hedge. The put hedge, put PUT hedge. Now, there's two very popular put hedges. The first one is the SPY, put SPY, and that just means we're going to buy puts on the SPY puts. And the other one is the QQQ. They had at one time they had 4 Qs, but I think it's back to 3 Qs because it was too confusing. Mm-hmm. But the QQQ basically is technology. I think it's 100 technology stocks, and the SPY is the S&P 500. Which is technically 500 of the top companies. Puts. I like to do the SPY SPY because it's just, I think, more balanced, and it reflects the overall market better. The Qs are good if there's a dip or a correction. A lot of times, technology will get hit first. So the technology stocks are going to be down. So people will sell the technology stocks in the case of a correction or decline first before they sell, for example, their consumables, right? Am I coming to?
Yeah.
In that case, if you had to put on the Qs, you'd do better, in that case. However, some corrections or dips, people don't sell the technology right away. So the SPY is better because it has an overall reflection of the market. You had a question, go ahead.
No, I was just going to say if you could elaborate more on, you said that technology usually gets hit first.
Well, I know this stat when there's a correction, 10% or a dip, 10% correction, 20%, it'll be, the people will be selling their technology first. They'll sell that first. A lot of times that has had, if you're in a good market, a lot of times technology has had gains. Like what's technology? Google, Apple, NVIDIA, right?
Mm-hmm.
And consumables would be like Philip Morris, right? McDonald's, Costco, right? Why? Because they deal with food, right?
Yeah.
So those ones will maintain better than technology. We can put that down. Most corrections, investors sell tech stocks first. NVIDIA, Google, and then consumables. And not only consumables, anything that's basically not technology, right? But here I'm going to put Costco, COST, PM, which is tobacco, consumables. And what was the other one? Hershey is chocolate, HSY. This is something that you can eat. And there's one more.
Walmart.
What did I say? What?
I think you said Walmart, no?
We can put Walmart in there, WMT. McDonald's, I said McDonald's. MCD, then it makes me think Starbucks, SBUX. That's like a consumable. Okay, so this second row of stocks are gonna sell after, because investors feel like, well, you know, if we have to cut back, you know, I need to eat, you know. We have our consumables. We're gonna still do that. We can't not eat. You know, we can do without maybe we can do without, you know, our technology. You know, what any technology, but we can't do without food.
So this
Starbucks.
is on, so Eric, this is on a dip. Now with correction, is technology also first to go up? Well, not. I mean,
yes.
Yes.
A good point. When the market corrects, technology is first to sell, and when we go back up, when we correct back up, it's first to go back up. Whereas the non-technology stocks tend to be slower, and they'll sell those secondary, and that's slower, and that takes longer to go back up. So basically, technology leads basically most all dips and most all bull markets and bear markets both. Make sense?
Yeah.
And the other stocks come behind that. You'll notice what I mean. You'll have to look at it. But that's just that's not a black and white rule. It just seems to be, it's more like a gray area. It'll happen more than it doesn't happen. Okay. You'll notice if you have a lot of technology, you'll get hit hard, like in a down day. You just notice that. And your other stocks, you know, McDonald's, you know, Philip Morris, Starbucks, they'll hang on a lot better. That's what I noticed.
Yeah.
Okay. So, and that wasn't even what I was talking about. I was talking about the put hedge. The put hedge is a position where you're going to put about, let's say it start about 5%. 5%. You're going to buy long puts, which means you're going to buy the put. In this case, buy put on spot. Now,
we're talking about hedge funds right now.
We're talking about a hedge. We're talking about the put hedge position.
Oh, okay.
Put hedge. I didn't say hedge funds. It's a hedge. Hedge just means it's like a protection against something. You know, it's like a buffer. You know, and the put hedge is you're going to put about 5%. Now, when I say 5%, how much money can we make on Palantir in 1 month on a cover call?
The premium that you gave me was, you can make 240 with
which is about what percent?
9.9, I think.
10%, close enough?
Yeah.
Okay, so what's the return? What's the return on our Netflix, on our other cover calls?
Let me go back into my.
Don't look. Just give me a percentage. Like we've been doing this.
6, 7, 8%.
It's probably more like 4% a month. But what I'm saying is, we're not just going to spend money to get a hedge position. We're using the money we gained from the cover calls. That's what I'm saying. Or if you have a trade that you made, that you successfully traded, what's that stock you traded? You got 3.5 points.
CCIV.
Tell me the symbol.
CCIV.
CCIV. Did you try to trade that one?
Nope, I held on. And they're down big, but it's all right. Yeah, I do believe in their future, though.
If you get a successful trade or dividend or cover call, what I'm saying is you can use some of this money for a hedge. That's what I'm saying. So the idea is that you're going to use the money that you made, that you earned. And the point of that is that you earned it. You're not just buying puts for no reason. Okay, so you get the money first from your covered calls, from your successful trades. In this case, we're gonna do 5%. Now we're gonna go out 6 months, put 6 months to 9 months. Okay, and let's say we have $100,000 account value, right? 100K. If we're gonna buy 5%, we're gonna spend 5% of that account value on puts. How much are we spending?
We're putting 5K on puts, you said, right?
5,000 on puts, right? 1,000 on puts. And that means we have 95% long. We can have some cash. We can have 10% cash, 85% long. You know what I mean by long?
6 to 9 months out.
No, long means, yeah, it could mean that. But what I meant to say is long means you're going to make money when the stock goes up, when the market goes up. So you're in long positions, meaning that you benefit when they go up.
So
and why I say long, because when I say, so then you're 5% short. 5% short, I mean, you're going to make money when the market comes down. That's what we're doing. So the put position, the 5%, $5,000 per 100,000, is a short position, whereas your other positions are long positions. You follow me?
Yeah.
So the short is the puts.
So long position are calls.
Yes.
Well, it could be many things,
yes.
but yeah.
Yes. It takes time to learn the lingo, but
Yeah.
I want to try to keep it simple for you.
Yep.
All right. So what we're doing is we're taking a small percentage of our account and we're giving us a protection. It's protection. It's insurance. You can call it insurance, or AKA hedge. So we are in a way spending some of our profits, but what we're doing is we're lowering our chances of losing. Write that down. We are lowering our chances of losing. For example, if we were to gain 40% return for the year, okay, which is a great year, by the way, and if you can do that, you're basically done. You don't have to just keep doing that, right? But if we're gonna have costs, so we're gonna put in a hedge just in case the market corrects or crashes, and let's say we're gonna, in this case, earn 5% less. So we're gonna turn that 40% into 35% profit. This is the plan. 35% profit. We're gonna put that 5% to our possible losses. So if we had, let's say, 15% losses, it's only going to be 10%. And if we had 5% loss for the whole year, which is possible for a trader, you're going to have a zero. Follow me?
Yep. Down 5% to 0.
So and that's what, and a down market is something you really want to study, because this is the most frustrating thing and challenging thing for a trader, especially traders, is that you can put time in, you can put the work in, have all your spreadsheets, and the market you can get a nice position. The market could come down, the stock can come down, and in 3 months you're showing a loss after 3 months, which is, wow. I mean, a job is much easier, because a job you're supposed to just show up, you do the job, and you get paid, right?
Yeah.
So you'll be up, but in the stock market, you can do your job, show up, work, and you can still have a loss. So that's one of the most frustrating things you have to deal with as a trader. And that's why I really push the covered calls and the dividends, because you have that to fall back on, right? How much money were we making in covered calls on average in the last 3 months? I'm training you to do. Just give me a figure, percentage-wise. In the last 3 months.
In 3 months, let's maybe do like 15%.
Let's cut it down to 12% because I don't want to overpromise.
Yeah.
So let's say 4% a month. So if we can get 4% a month, we know Palantir plays 10%, but if our average is 4% a month, and we did it for 3 months, which we've been training for 3 months. I've been telling you. I think I told you the first session about the cover call. Did I?
Yeah.
That's 12% return. So at 100,000, we can be about 112,000, right? But now let's say the market dips and our stocks dip. Let's say we're down 10% after 3 months, right? Down 10%. So now what does our account look like?
Up 2%.
Right. So the investors who don't trade, who just hold on to the stock, they're down 10%, right? But the cover call writers are up what?
2%.
Plus 2 covered call writers. Traders. Which is to say that investors, there's two basic strategies to the market. One is investing long term. The other one is trading. And investors basically, for the most part, they just buy and hold. They tend to do great over time, especially if they have good stocks. Especially, not all stocks are good, and we talked about the criteria on that. But in a nutshell, if you're going to invest for 10, 20 years, you're probably going to have a decent return if you're in good stocks, because the market tends to maintain and go up. We have companies that make profits. Their stock goes up. Their stock is favored. Apple, look at the 10-year chart. That's why we look at 10-year charts. Nike, Starbucks, Chipotle. Chipotle's dipping, by the way. Chipotle, it's getting some down. It was down to 1,300. Okay, so the problem with investing is you don't have the cash in hand. You can't live off your account. You can't take money out. If you wanted money, you have to sell shares. If you sell shares, you become a trader. You start trying to time the market. When do I sell? When do I buy? And on the other side, you have a trader. And the traders have an advantage because they have the cash in hand. They ultimately can live off their account, and that's what I'm teaching. They generate money monthly to pay the bills, live off their account, and they have to trade. Dividends are great income, so are covered calls. And if you can do some mild, I call mild monthly trading, put that down. Mild monthly trading, no risky day trading, mild monthly trading. You can make money. So you can start in the market and let's say we're at 100,000 and we invest in our stocks and month 1, month 2 they go up. Month 3 it goes up. We're at whatever 10% gain, whatever we're at, 15% gain. And then in one day or in 1 month, the third month, end of the third month, it all comes down back to where it started. Mm-hmm. Basically, we lose everything, all our work. It's not loss technically, but on paper, you're showing that you've made no money. It's a loss. And that's why you trade, because you can say, hey, look, I should have sold when it was up 30 points. Why didn't I sell? If I sold, I would have been profitable. You get me?
Yeah.
Am I just rambling on? Are you with me?
People get greedy. Now I'm listening.
So when you trade, you're able to make a plan. Write this down. We make a plan, form a plan a trade, and we can sell at a profit. And that's why trading is you have the cash in hand, so you have an advantage there. Though it's more difficult because it's more difficult to time the market. When to sell, when to buy. So that takes a lot of skill. And that's why a lot of traders lose money, because they're not good at it. and we're learning about trading. So we're going to talk about a couple different trades. So when you're a trader, you have to sell at a profit and you have to make money. When you're an investor, you don't really have to do that. Just basically buy and hold. When there's a correction, sometimes you can buy more or you can sell, but long-term investors, for the most part, they just hold through a correction. We'll put this down. Long-term investors, they hold through a correction.
They hold through a what?
They hold through a correction. Long-term investors hold through a correction. Traders trade. And here's one trade we're talking about, the hedge. Okay. Put hedge.
So what exactly does a put hedge entail? What are we doing? So we're buying a put that's 6 to 9 months out?
Yeah, we're buying a put, in this case, on the SPY. So can you pull up your option chain?
Yep. For which stock?
SPY, SPY.
Got it. All right.
Let's look 6 to 9 months out. What options are available for us? If we're in March.
So we got April.
Look at November, December, January.
Yeah. Let's do December 17th.
Okay, we'll do December.
Yeah.
That's 8 months?
December 17th. Yeah, something like that. What are we in? It'll be April, May, June, July, August, September, October, November, December. 9 months.
9 months. Now I like to go 20% below the price, because that, to me, like if a lot of corrections about 20%, crash is more like 30 or 40, but the next correction is about 20%. So you'll get some good action if the SPY comes down 20%. So I like to go. So if the SPY, what's the SPY right now? The price of this?
376.72.
Now, what's 20% off of that?
I'll tell you right now. Hold on. Okay. 0.72. You said 20%?
Yeah.
That's $75.
So like 301. Let's just say 300. We say 300.
Yeah.
So we're going to look at the 300 puts. So in other words, if the market was to go down to this point, we would have some meaningful gains in our put hedge. So what are the puts? About 300.
By 300, puts are very expensive. Oh, my fault. I'm on the wrong.
Not calls, puts.
Yeah. All right.
Puts should be cheaper.
I know. So what number do you want? What are you looking for?
The 300.
The 300 is 11.89.
Now you can buy the 320s or the 280s, but 20% off the price is what I like to do. It just works better. Okay, so 11.89. Let's just say $12. Okay. So how many puts can we get for 5,000?
How many puts could we get for 5,000? We can get. What do you mean?
If they're $12, which means they're $1,200 per put. Follow me?
Yeah. So we could do 4. About
4 is 48.
Yeah, it's about
4 times 12 equals 4,800. Okay. So we're gonna get plus 4 puts. December 300. At a strike 300. 412 equals 4,800. So here's the trade. We're buying 4 puts, December 300 for $12 each is 4,800. Basically, it's been about 5,000. And that's gonna. So what's gonna happen if as the SPY comes down, and it will come down, we don't know how much, then our put position will go up. Okay, so while we're losing on our calls, our long stocks, their shorts will go up in value. Make sense?
Yeah.
So and we already identified that we can make 5,000 like easily in a month, right? With some of these cover calls, or if you do a successful trade. So you figure you're not spending a lot of money. It's not costing a lot. It's costing basically 1 month of gains. Okay. And like mutual fund managers, they have to buy puts because they don't want to lose money. They can't afford to. And if the market's crashing down, they try to trade it. They will be buying the puts. They'll be shorting. So that's going to, if they do it right, it'll lessen their loss. So we have our put hedge here, and it'll lessen our loss when the market comes down. Follow me?
Yep.
We have two choices basically. Here's a choice. We have one choice, two choice. The first choice is, let's say the market dips nicely, let's say in July for the summer. A lot of times the market comes down for the summer. So we have a profit on our puts. First choice, we can sell. So let's say, I don't know, let's say we make, let's say we make 3,000. Not a lot, but that $3,000 is going to offset $3,000 of losses in our other stocks. That's the whole point. So we can sell, we can take the profit. That's the first thing. Follow me?
Yep.
Sometimes your puts will double. It'll be 5,000. Put 3 to 5,000. Option two is we just hold it because we don't know how long it can go. The market can go into a correction, then that could lead into a crash or a bear market. So this $3,000, this $5,000 position can become 10,000 or even 15,000. It can double or triple. So this can become 15,000. And then we have protection on how much. How much do we make?
If we make, let's say, if it doubles or triples, so let's say we make 15.
Hold position.
You heard me?
No.
So let's say triples, we make about 15 on it, and it can offset. 15.
Well, you come out with 15, which means you made 10,000. It can offset 10,000 in losses.
Yeah.
If it goes up 15,000, you can offset 15,000 in losses. Sometimes when the market comes down and there's definite bear tones, you can add to your put. That's another thing, but we're not going to discuss that today. Just that we're gonna have something as protection, as insurance. We can afford to buy it. It's going to help us when the market dips, and we can't afford to lose money, and that's what we do. We're protecting ourselves with the put. So if we hold the position, we're just going to have it, and as far as it goes, it's just going to be there because it's going to balance our account basically. And here's the end result. What usually happens? Let's put the plan in December or before. You might have a little, like if you sold it with a $3,000 gain, you might have a gain, but 9 times out of 10, the market will be okay, and basically you just kiss that $5,000 goodbye. So it's a loss of $5,000, but it's a worthy cost to protect our $100,000 account, and we can afford it because we're getting money monthly, right? Cover calls, right? Yeah. So 9 times out of 10, you're going to basically kiss that money goodbye, unless you sold at a profit, But the point is that it'll protect your whole account from losses, and if the market maintains and goes up, these puts are going to go to zero. You see my point? Yeah. And So after 9 months, so in December, we'll do it again. We'll put another $5,000. This position will close out, put another $5,000, and we'll buy something for next year. We're going to go 9 months out again. You see? So you have to have some kind of. It's like having fire insurance. In case your house burns down, you don't want your house to burn down, but it's just a cost that you have there. So we call it a put hedge. Any questions on that?
Nope.
Does it make sense?
Yep.
It's a cost that we can afford. We earned it, and it's going to help us long term if and when the market comes down. And oftentimes the market maintains it goes up, and it's just an expense that we have. But sometimes we'll have a deep correction or a crash, and then we'll say, hey, we can sell at a profit, option 1, or choice 2. We'll just hold it and see how far this thing goes. And that way we're showing a gain on our puts, and we're showing a loss on our long positions. Okay. Sometimes you'll see, you hear about traders who, they are traders, by the way. If they're going to make money in a crash or correction, you say, hey, I had puts, so I was okay. So, or I had some puts, so it didn't really hurt that much. Some people lost 30%. Oh yeah, well, hey, Mark, the market corrected. It was down 30%, so you must have got killed. I know you're in stocks, and you'd be like, well, I did okay. We made 30% for the year, and I also had puts, so I actually made money. You can tell them if you do it right. So that's an advantage that a trader can have over a long-term investor. Long-term investors don't do much trading, so they don't have the advantage of being able to buy and sell hedge positions. Make sense?
Yeah.
Let's talk about 2 more positions. Let's talk about 2 more trading options. One is, well, have we talked about when to sell a stock?
I remember with call, when to sell options or when to sell stocks in general.
In general.
I remember with calls, you said about 30% is a good time. I remember you told me about a month ago.
Good. Let's continue on that.
Yeah.
Okay, so when to sell. For stocks, you can sell when you have it depends. You have to have a plan. So you have to say, listen, I got a stock. I'm going to do a trade. I'm going to make 10% on the stock. If it's Starbucks, you buy it at 100, sell it at 110. Okay. That's $1,000 gain if you have 100 shares. Okay. So when to sell, you can sell at 10% profit, 20% profit, and more. You can save 30. You can save 30% profit or more. So you just have to pick your exit. I'm gonna make 10%. You stick to your guns. The stock goes at 10%. You sell. So here's the.
Eric, there's never really a good time. You'll never really know when the good time to sell is. I think it's just according to whatever your plan is.
Right, but that's the point. We're making a plan. If you want to make 10%, let's say you want to do a 2-month trade. We think it can go 10 points. We'll do 10%. We'll pick it. And if it's a longer term trade, 6 months, maybe you want to get 20%. We can pick that. If you want to do a trade, you want to hold it for a year to see how much it can make me. I'm gonna make 30%. And here's the value. If we work for 3 months and the market stock went up, we have a chance to trade it. We have a chance to sell and take a profit. And the market could come down on month 3 and you have nothing. All that work is gone if you don't trade. So this is why you have to stick to your guns and you have to plan your play and play your plan. Write this down. You plan your play and play your plan. Your play, then play your plan. Remember, you have to be accountable to Mr. Morgan. He's going to want to show a profit. He wants to see your portfolio So you have to make money as a trader. Okay. You can't afford to let the market do whatever it wants to do. So if you have a stock, give me a stock.
Any stock?
Yeah.
Should we do our Apple example?
Do our Apple.
Apple.
You buy it now at 120. Let's say we want to get a 10% gain. What's that in points? 120.
Apple,
You
120.
want to get a 10% gain. What do we sell at?
We would sell it at 132.
Perfect. 132. And when it hits 132, we're out. We made the profit. It could go higher, could go lower. We don't care because we made a plan. We stuck to the plan. Make sense?
Yep.
Now, let's talk about losses. And this is important. A lot of traders don't like to talk about losses, but we have to talk about the loss now. So if we're going to get a 10% gain, we also have to, if the stock goes the wrong way, if we buy it at 120, stock's going down 115, 114, we also have to sell. So give me a percent we're going to sell at.
We could sell also, let's do like 7%.
Okay, good. I like 7% because it's less than the 10.
Yeah.
So what's 7% of 120?
7% of 120 is $8.04.
Let's just say 112. 112. If it goes to 112, man, this is the mentality. Okay, look, I'm about Apple dipped. It's 120. I think I see a trend. I think there's some support. I buy 120. It should go up, right? If it goes to 132, I'm great. I'm out. Made a profit from Mr. Morgan. Made a profit for my clients, and I'm happy. I'm done. I'm gonna go into cash. So, but if it goes down, look, it's going down 115, 114. If it's 112, I can't take any more losses. I'm going to cut it 7%. Perfect. Okay. And I'm going to take a loss and go back to the drawing board. Okay. So in this case, we'll take a loss of 7%. We close at a loss. Can I tell you 2 good reasons to sell at a loss?
What?
Are you with me? Can I tell you 2 good reasons to sell at a loss?
2 good reasons. Let me hear it.
First one is to stop losing. Is to stop bleeding. Is to stop the loss from losing anymore. It's to stop losing. 1. Stop losing. Because you can lose more, right?
Yeah.
The second reason you want to sell a loss is to save your money for the next position, to save your money for the next position.
By the way, Eric, could we go over tax write-offs?
Yeah, that's let's do a session on that.
Yeah.
So I can finish up the trading.
Mm-hmm.
But in a general sense,
because I find that very valuable. By selling at certain times, even when you're losing.
Okay, so if let me just say a couple things. I don't want to negate your question. First of all, I'm not a tax guy, so you're going to want to have a proper tax accountant. But I know a few things. One, if you're doing stock trading, if you hold a position for a year, you pay less in taxes when you sell, or longer. If you hold it for a year or longer,
What did you
if you
just
hold
say?
a position, if you hold a position for a year or longer, you pay less in taxes. It's like 10%. Whereas if you trade the position, like if you sell it within a year, which we're going to probably do more than likely, unless you're talking about your IRA or your long-term positions. Besides that, we're going to be trading. So we're going to pay maximum tax as if it was income. And that might be like 25%. Under tax plan, under Trump tax plan, it's 22% what we're paying in taxes. So we will pay more if we're trading as opposed to long-term investing. That's the first thing, right?
Yeah.
So you have to hold it over a year to get that benefit. They do that so it'll it tends to stabilize the market. You know, some people don't want to sell because they'll pay more in taxes. You know, you have a good stock, Apple, whatever, Netflix, and you don't want to sell it because, hey, you know, if I hold it for a year, I only pay 10% taxes. But if I sell it, you know, right away, if I trade it, I have to pay maximum taxes as if I earned it working a job. That's the first thing.
Mm-hmm.
The second thing is for tax write-offs. Basically, if you're a full-time trader, you can basically write everything off as a business. You're a business person. You're an independent contractor. So everything's an expense. Like, this is for any business person. So like you can write off your uniform, which is your clothes. You write off your car. You can use your car for business, company car. Write off your gas. You see, so you have a lot of write-offs, not just for stock, not just for full-time stock trading, but for any business. Your costs are basically write-offs. So if you have, let's say you make $30,000 at the end of the year on a $100,000 account, your costs, you might have $15,000 in costs. So you only pay tax on $15,000. Follow me?
Mm-hmm.
So that's one thing. Another thing is if you are working a job, if you have, if you like work at whatever, Home Depot, or you work for your dad or whatever, and you have a paycheck, and your paycheck is more money than your stock trading, you can't be a full-time business person stock trader. You're basically doing stock part-time. So if you're making more money in a job, or then you don't get those write-offs. You don't get those write-offs. You follow me?
Yeah.
You can get some basic write-offs. Make sense?
If your salary is more,
yeah,
than investing income.
That's a general rule. You're just basically a part-time stock person. You're not going to be able to get those write-offs. You're basically an employee. It's being an employee versus being an independent contractor or a business owner.
Yeah.
Business owner, you can basically write all your costs off. If it's a cost, you write it off.
Yeah.
Like, for example, I can write off 50% of my entertainment. So even if I go to dinner, I can write that off as a dinner, as a business meeting, as an entertainment expense. Make sense?
Yeah.
So there's definitely a lot of advantages to being an independent contractor or a business person over being an employee, but you also have all the responsibility. You have all. It's relying on you. You don't just show up and do a job and get paid. You have to earn your paycheck. You have to get a good stock, hopefully write a good cover call monthly. And if you do some trading, trading has to be excellent. Dividends. You're earning the money, right?
Yeah.
And the buck ends with you. You might even have hire an employee, do all your spreadsheets, keep track of your accounting. You know you're hiring your tax agent if he's doing your taxes. That's like an employee. That's a write-off. You know, the cost for doing your taxes is a write-off. Okay.
Yep.
What's our time like?
It's 5:11.
Let me just quickly wrap up the trading. Then we'll call it a day.
Yeah, you
So
said
here's
number 1, stop leading, and number 2, save money for the next position.
Yes, good. So here's the thing. Here's the point of this. You can do a 7% loss. You can even put your loss. I'm gonna just put at 15% because I know Apple can dip. I know it's dipped, so I'm gonna put 15%. Right? That's fine. You have a loss at 15%. Right? But here's the thing. What this is gonna stop you from doing is if the market really corrects. So the stock you're in, I don't know what stock you're in, but maybe it's not that good. It starts dipping and dropping. There's stress. You have to. There's anxiety. You're losing money. You have to do something. it's going to stop you from having like a greater loss, like of 40% or 50%. That's what it's going to stop you from. And it does happen where your stock, which was a great stock at one time, starts coming down. Now you have like a 50% loss. You don't want to endure that as a trader. Okay. So you're going to cut it at 7 or let's say 15. And that way you have a maximum loss of that amount. Make sense?
Yeah.
I was consulting a nice lady who, and we were in the stocks called, it was Checkpoint Software. They do security systems, so security software. So we were in the stock and we got in, I'm gonna say about 80, and it went to like to $200. This is back like in the 90s, and it more than doubled. The stock more than doubled. And when it doubled, I said, hey, listen, let's sell. It's time to sell. You know, this is a long-term trade. It was like a 9-month trade. We put our time in, we did our homework, we watched the stock, we bought, and we're going to sell now. And I sold. And she didn't want to sell. She didn't want to sell. She said, no, I'm not going to sell. She decided to be a long-term investor. What ended up happening is the stock had a lot of hype, and it had a lot of, it was trading at a very high PE, and it started to lose favor because there was competition coming into the market. There's other companies doing the same thing. You follow me?
Yeah.
So the stock ended up going back down all the way to the price you buy that. Then she started losing money, started going down below 80. And she came to me. She goes, what do I do? I said, I told you to sell it. What do you want me to do? You know, you didn't sell. So the point is when you're going to sell to protect yourself from a greater loss. And, you know, don't come to me in a seminar saying, hey, you know, I lost 50% or even worse, 80% this stock. What do I do? Well, you should have sold, you know. What was your sell price? Hang on 1 second. Okay, so let's quickly cover options. Options move a little bit quicker. Okay, so with the option, you can sell at like 25%, 50% gain, or 100% gain. 10% gain is not gonna cut it because an option can move 10% in one day. Follow me?
Yeah.
The option you're gonna sell 25%, 50%, or 100%. And then we'll take a loss. I'm just gonna put the number there for you. You can pick your number. I'm just gonna say 33% or 1/3. So if you buy a call option for say 12 points, let's say 10 points, okay? When do you sell if you're gonna sell it for 25% profit?
So if we get a premium of you said $12.
We pay. Hang on, no. We pay 10 points, which is $1,000 for the
this
option.
is call? Gotcha.
Yeah.
Gotcha.
What if we're gonna get a 25% profit? What do we sell it at?
And it costed us $1,000.
Yeah.
That means that we'll sell at $1,250.
Exactly. Perfect. So we'll sell at $1,250. Now, if we sell at 50% profit, what are we gonna sell at?
50 would be at 1,500.
Which is 15 points for that option. Perfect. And we wait out for 100% profit. What are we gonna sell it at if we buy it for 10 points?
It would be 20.
And remember not to get greedy. You know, you can have a lot of options that will double, and you'll see it. You know, and that's like more of a long-term play. You know, 3 months, 6 months. But here's the thing: if my goal is to get a 50% return to sell at 15, your goal is to get 100% return to sell at 20. Who's going to get that goal faster?
You.
And who has the easier trade?
You.
You can try to get 100% return on your option, then go to 90%, and then go right back down.
Yeah.
You see, and then you wish you. Okay, so just put here, don't get greedy. Get greedy.
We spoke about it in one of our lessons: percentage gain versus accuracy.
Yes, and if you can get 50% return on an option, you know, is it easier to get 25% return or 40% return, you see? So you have to make that judgment call, you know?
Yeah.
Now let's look at the loss. I like to say a third because a third is just a nice round number. If you buy it, let's say at 15 points, you want to sell it at a third loss, you're out. You don't want to sell it at that, but you're out at that point. What do you sell at?
That means that it's gonna be,
If it's 15, a third less is what? Just think fives. There's 3 5s in 15. One third less is 5 less, which is
1450. So then it would be,
it's 10. It's 10. It's 10. So if you buy a 15, a third less is 10. 2/3 less is 5, right?
Mhm.
If you sold it at 5, you'd be losing 66%. 67% actually. Okay, so if you bought a stock at if I bought an option at 15, a third, cut your losses at a third, you would sell at 10. Follow me?
Yeah.
If you bought an option for $3, okay, and sold it at a third loss, what would it be?
At $2.
2. But that's like,
Yeah.
at that point you want to get a higher option because I feel like an option that's $3 could easily move to $2. And then finally, if the option is 30 points or $3,000 per option, and then we sold it at a third
It'd be
loss.
subtract 13. So it'd be selling at 17.
No, 20.
Oh,
Third, 1, 2, 3.
Third. Oh, okay.
10, 20, 30.
Yeah.
10, 20, 30. So 30 points minus the 30 is 20 points. Make sense?
Mhm.
Or $2,000. Okay.
Call me when you can.
Okay. Any questions on that?
Nope.
Finally, the point is you're gonna sell at a third because the option went the wrong way. We'll take a loss and we're gonna go back to the drawing board. We're not gonna lose any more money. We're gonna save our money for the next trade, and hopefully it's a much better trade.
Yep.
Cut our losses at a certain point. Sound good?
Yep.
So next week is session 10.
Yeah.
All right. Thank you, Mark.
All right. Take care, Eric.